Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning and we're coming to you live from the CNBC TV18 Motilal Oswal studios. It's an important day because of what has happened in the last 12 hours or so with respect to that Fed decision and markets which have taken it not very well. I'm Prashant, with me, my colleague Sonia and Nigel. Guys, hi, morning.
Hi,
morning.
Good morning. I want to know, did you stay up to watch the Fed?
Even I was up to
That was your question. Tell us the truth.
I mean, I think that I told you guys this, right? The last time I think I sat up and watched markets was, I think for a brief bit in 2020 where markets were all crashing, etc. And before that was 2008. So crisis to crisis.
Okay.
No crisis right now. So,
That's a good sign, actually.
let's just quickly then take this forward with what you need to know as far as the trading activity and trading action is concerned. So the Fed decision came through, and as expected, there was no change. But the policy, on a whole, I would say, was more hawkish than expected. And the reason is very simple. Basically, the Fed's forecast of, not forecast, but their assessment of the U.S. economy is much stronger than expected. They've raised GDP growth forecasts for 2024 and 2023 and 2024. And they've brought lower how many rate cuts are going to be. I mean, their forecast of rate cuts by 50 basis points, both for 2024 and 2025. So, if markets were expecting 100 basis points, now they're expecting 50. I mean, they should expect 50 basis points if you go by Fed's forecast. And this is the reason why, I'm saying that this was more hawkish than expected. You can flip this around and say that, the Fed does not see a hard landing. They see a very soft, smooth landing, no recession as far as their forecasts are concerned. But the point is that would also mean that rates perhaps would need to be higher for longer. No rate hike, as I said last night, but, the statement was unchanged, which means that perhaps is going to be one more rate hike sometime in 2023. And beyond that, the quantum of rate cuts has been brought lower. So what did we see, right? I mean, the dollar index, if you needed any evidence for market reaction, you could look at the dollar index pre-FOMC and post-FOMC. So the DXY basically went from 104.6 to 105.36 over the course of the FOMC decision and the Powell press conference. So that was quite something. Yields popped higher. The 2-year closed above 5.17%. I mean, that's, quite high. The 10-year basically ended at the highest, I think, since 2006. So that's now at about almost 4.4% or so. And of course, the yields feed into the dollar. The dollar feeds into what's happening on the yields. And equities were lower. So if you look at the Nasdaq, that was down about 1.5% overnight. S&P was down. The entire complex was down, not in a very large way, but there were cuts, as you can see up on your screen. You could say that we kind of preempted some of that yesterday because the Nifty and the Bank Nifty both saw sharp cuts by about 1% or so, a little over 1%. It was lesser so on the mid-cap index, which lost about 0.25%. The small-cap index lost just under 1%. So the larger cuts were in the Nifty and the Bank Nifty, largely because, of course, HDFC Bank. But to kind of limit ourselves for now on the levels you need to watch out for, what we're basically looking at is retracements now. If you look at the retracement of the rally on the Nifty and the Bank Nifty from the August 31st low to the September 15th high, basically 15 days, lesser in terms of trading sessions, the 38% retracement of this move is the first support. That comes in at 19,840. Most likely we'll kind of breach that right at open. So then the next one will be the 50% retracement of that rise, 38,650 and then 61.8. The 50% retracement is 19,723. Will we get to that number in this leg of the pullback correction move? I think so. Let's watch out for. So I think, a safer, more if you're trading a buyable kind of zone would be closer to about 19,700, 19,750 or so, and not the first gap down that you see. Resistance is perhaps at the gap area between 20,050 and 20,115. This is the gap between the sell-off, Monday's low and yesterday's high. So that's 2050 and 2115. On the Bank Nifty as well, we closed near the 38% retracement, same sort of rise, right? In the case of Bank Nifty, it's not 31st of August, but 1st of September to 15th of September. The 38% retracement of that is 45,363. We closed around that. The real supports then come in at the 50 and the 61.8% level. So that stands at 45,070, which is about 400 points, not even 400 points away. And then 44,778, which is the 61.8%. That's a big one, which you need to watch out for. And resistance for the Bank Nifty, similar gap area, which is, in the case of Nifty Bank, is 45,726 and 45,907. Don't do anything right at the word go. Let the market settle a little bit, stew a little bit. We've had a nice run. The first signs of a bit of a pullback yesterday, at least on the large cap. So, give it time for things to settle in. And I mean, if you see, prices coming to the lower bounds that I mentioned, both on the Nifty and the Bank Nifty, that's a much better risk reward rather than, trying to buy the open right on the gap down. Sonia.
Absolutely. And, the GIFT Nifty for now is implying a 120-point cut, right, in trade. So we're going to start off straight off the back with a gap down opening in trade. And then, of course, we'll take it from there. I think the big focus area, at least for me this morning, is the IT space. So generally, when, there are higher rates in the system, growth sectors like IT see some compression in terms of valuations, etc. So that is definitely going to be one space that I'm looking at today. Nasdaq, where, a tech-heavy Nasdaq saw a big fall yesterday. It was down about 200 points, although the Dow ended with mild losses. So perhaps you could see disproportionate pressure in the IT sector. So that's that. As Prashant was also pointing out, the Fed has been signaling or has signaled higher rates for longer. The exact statement verbatim is Jerome Powell saying that we are prepared to raise rates further if appropriate. So it's going to be very, very data dependent from here on. But the problem for our markets is, even in trade yesterday, you saw a secular fall. So there's profit booking across the board, whether it's HDFC Bank, whether it's Reliance, whether it's in PSU banks, which have rallied so much. And now today there will be pressure in IT. So there is no leadership pocket in the market that will hold fort, at least at the start of today. Then, of course, we'll take it from there. Both foreign and domestic investors, in fact, sold in the cash markets yesterday. And if you look at it, it's been 2 days of large FII selling, and put together in the month of September alone, FIIs have sold almost 14,000 crores. So, it's not a great picture that we're looking at the moment. And of course, the Nifty closed below that 20,000 mark yesterday. Another asset class to track closely now is the move in gold. Gold prices have started rising. It generally happens when risky assets take a backseat on account of higher rates. So just these are how the internals are stacked up. Of course, today looks like it's not going to be a good day for the bulls, but then we'll take it from there.
Well, that's right. Sona, the only good point about yesterday and today is yesterday maybe we preempted some part of this fall, because the Nifty and the Nifty Bank, it was a very, very weak close. There's no two ways to describe it. The intraday chart, if you just look at it, the last stick was actually the low point of the day. As I said, only lone positive could be maybe we preempted the hawkish pause that we saw from the Fed. But there's no big shorting that we're seeing in the system. And actually, this market had got very, very complacent. There were long positions getting added on a day-to-day basis. So yesterday as well, we had a lot of unwinding of long positions. And from the FIs as well, they unwound long positions big time, though they continue to remain net long with their positioning at around 61% odd. But massive unwinding of long positions is what we saw. There's another technical factor that you normally track. That's the PCR. It was at around 1.2 odd. It's come down to around 0.79. Remember, when it goes to around 0.65, 0.7 odd, that's when we see the markets, see a bit of a near-term relief rally. So that could be one trigger you'll have to keep your eye out on. And why has the PCR come down so drastically? Because two strikes were very, very active yesterday. 20,000 call, you had the 19,950 call. Between them, they added more than 2 crore shares out there. And there was aggressive writing that we saw. That's about the call side. On the put side, well, you had the 19,900 put. That has the highest open interest. Premium out there was roughly on an average of close to around 50 rupees odd. So on the downside, on a closing basis, you don't want to see that lower level getting violated. That's 19,800, 19,850 for starters. We'll start around those levels, but on a closing basis, you'll want to defend that. Otherwise, you slide down to the 20 DMA, which is at around 19,650 odd. The Nifty Bank, that played out a weak close yesterday, and there was aggressive call writing that we saw. 45,500 call, premium roughly around 400 rupees odd. So that 45,800 to 46,000 odd mark, that becomes a key resistance zone. And on the downside, you're looking at the 20 and the 50 DMA. That's 400 points away from current levels. So you'll want to keep an eye out on that. The GIFT Nifty is suggesting a pullback. As I said earlier, the only good news is yesterday we ended at the day's low. The bulls will be hoping for a bit of a bounce today. Let's see how this one goes.
All right, Nigel, thanks for that. But before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Peter Cardillo of Spartan Capital Securities will join us to discuss the global trade setup. Our research team, a little later after that, will get you CNBC TV18's list of top stocks for the day. At 8:30, Hemang Jani will be our market expert to talk about what he likes in this space.
All right, let us quickly begin the show with a comment coming in from Eric Fishwick of CLSA, who says that the Fed has left rates unchanged. This is in line with expectations, and the meeting was more important for changes to the Fed's forward guidance. The guidance for rates this year was left unchanged. The median Fed funds projection for end of 2023 remains 5.6%, but has risen to 5.1% from 4.6% for 2024 end. They have long argued that the Fed would want to keep rates higher for longer, but this is more hawkish than what the street was expecting.
Another equity call, this one from CLSA's Lawrence Belanco, who says that they continue to flag the vulnerability of the Indian NSE's mid-cap space. He says the bearish intraday reversal recorded on the 12th of September, which is last Tuesday, reinforces their call on the 1st of September, which was to take profits. He says a break below the 20-day moving average on that index, currently at 39,780, which has acted as a key support level since the mid-cap index broke out of the 2021-2023 consolidation pattern in May, would add further evidence that a consolidation pattern is unfolding. He anticipates further corrective price action of the September 12th high that at the very least is set to take the mid-cap index back towards 36,874 to 38,148 area in the coming sessions. He says in addition to Power Finance and IDFC First Bank as take-profit candidates, they would add Trend, MRF and Max Healthcare.
Okay, let's also get you some money market views this morning and tell you how to approach that space. Parul Mittal Sinha of Standard Chartered Bank says higher crude oil prices, stronger US dollar post the FOMC and a wider than expected merchandise trade deficit is likely to keep the rupee on a weaker footing. However, she expects the dollar selling by the RBI to smoothen any sharp moves, and thus the dollar INR pair is likely to trade in a broader range of 83 to 83.40 next week. Any positive news on the bond index inclusion can, however, see a break of the range on the lower side.
Okay, well, that's the rupee outlook on bonds. She says that the 10-year benchmark bond yield is expected to trade between 7.15 to 7.25%. She says expectations of slowing domestic inflation and optimism around index inclusion is likely to keep rates supported despite higher crude oil prices and US Treasury yields. Hawkish FOMC dot plots showed fewer cuts in 2024. She adds a more favorable supply-demand balance from October is also likely to keep bond yields contained. Any positive news on index inclusion can see a move towards the 7% levels.
Well, we have a lot of stock-specific action to track for you. We get to that in just a bit for now, but for the timing, let's highlight all the stocks that we will be covering in our special Top 10 segment. We're looking at Sheela Foam, Strides Pharma, Biocon, Exide Industries, MCX, Sri Renuka Industries, and those are stocks on the back of positive news flow. While on the flip side, you have SJVN, Cipla, Apollo Tyres, and Fino Payments Bank that could be reacting to negative news flow.